Today we're kindly hosted by Antipodes, who specialise in global equities. They have 30 experienced investment professionals based here in Sydney and London, and offer a pragmatic value approach to identifying businesses at real value prices whilst managing downside risk. Today we're hosted by Alison Savas, who is responsible for communicating their investment approach whilst also their market views, and very, very strong on global equities. Alison, thanks for having us.
Oh, thank you for having me.
In terms of the markets, they're obviously trading at their highs. The S&P 500, for example, has recently reached 6,700. Yep. I guess the question is from investors, where to from here?
Yeah. Look, I mean, you're right. We're sort of 15 years into a bull market. So the bull market has become very mature. And look, we know that as, the cycle mature, risks build. So we'd be reluctant to say that, how much this momentum can take us higher. Look, we're certainly finding lots of opportunities in the US and also globally. So there are lots of interesting companies to buy. But we are mindful of risks that are building as this cycle has lengthened. And so something we're watching particularly closely is the US labour market. That market is cooling. You've gone from a very, very tight labour market to one that's much more in balance. You've had very high policy rates, which has put a lot of pressure on highly leveraged corporates, which account for 20% of total employment in the US. So we're not seeing mass layoffs, but low hiring, low firing, wage growth has weakened, and any further cooling can see higher unemployment, which would feed into weaker consumption, weaker activity, and so that's something we're definitely watching out for.
The US tech giants, obviously Nvidia's and the like, yep, has obviously been the locomotive for strong performance for the last several years.
Yes.
So do you see a more broadening of the constituents within, say, the S&P 500? Or is it still going to be more of the same for the next couple of years?
Look, I think what we've already started to see this year is we have had a bit of a taste of some broadening. It was really kick-started earlier in the year from the arrival of China's DeepSeek and also just uncertainty around Trump's policies. So the drivers of global equities this year actually do look quite different from the last several years, which have been very US quality mega cap dominated. This year we've seen emerging markets outperform, driven by China. Europe's performed alongside of the US, and so we do think that broadening can continue, driven by a change in fiscal impulse. The US fiscal policy, that's going to start normalising from very, very extraordinary levels. But then on the other hand, you've had Trump galvanising China and Europe into spending a lot more. So spending more on consumption and investment in that part of the world. And then we're seeing regional shifts. So yes, we are seeing, tech is a big theme, but I think while the market's very fixated on a handful of winners, it's missing that we've got this really interesting infrastructure-led investment cycle that's already underway. So we think that you can get a change in that US mega cap driven dominance. That can change. But look, AI is a structural investment trend that's here to stay. And in our portfolio, we like Alphabet. We've got exposure to Amazon. We've got exposure to Microsoft. We think these businesses certainly can be AI winners, and they're cheap relative to their growth profile. Certainly can see shifts, but there are some mega cap tech stocks that we think can sort of hold the course.
Outside of the US, you mentioned emerging markets, but outside of the US, where else do we see opportunities?
Look, if I look at our portfolio and I think about sort of where our key overweights and underweights are relative to the index, we've got around 30% exposure to European equities. And that bottom-up valuation sort of driven story in Europe's been interesting for a while. That bulk of our exposure or our overweight to Europe is really focused on global multinationals. So these are companies that are global leaders. They generate their revenue and earnings globally, but they're listed in Europe. And that listing in Europe has meant that they've been cheaper than peers listed elsewhere in the world. And that valuation discount can be as much as, it can be 30% or sometimes even a bit higher. So stocks in our portfolio that spring to mind would be Siemens Energy or Siemens Parent or even something like Airbus. Domestically, European exposure, we like financials. Again, sort of two holdings in our portfolio would be French listed bank SocGen, UK bank NatWest. These are well capitalised banks. We see net interest margins expanding, and have a very high distribution yield. So both of those banks are priced at around 6.5 times earnings, with distribution yields in the low teens. And that's very attractive relative to US banks and even relative to banks in our own home market. And then also not forgetting that sort of fiscal impulse I called out earlier. Europe's spending more money. And look, we're seeing it in Germany, spending on defence, security, infrastructure. That spending that they've announced. And look, it will take time to flow through, but the spending that's been announced is around 3%, a fiscal deficit of 3% of GDP, could add 2% to growth per annum. And look, we're just coming from a very low base. So it can, give a bit of impetus to earnings growth and also to forward multiples.
Seems like a distant memory, Liberation Day, when the trade policies initially came out with Trump. Yeah. So what do you think the future impact now is of his policies?
Look, it's hard to know. We're dealing with a highly unpredictable administration, and so that's tricky in itself. The way we're thinking about that sort of broad unpredictability is we just want to be, lean back on our philosophy and our process. You called out pragmatic value. It is buying companies that are attractively priced relative to that business resilience and their growth profile. Really focus on managing risk in the portfolio, both at that stock level. We want stocks that have multiple ways of winning. We want to be disciplined on valuations. And then managing risk at that portfolio level where we want to have uncorrelated sources of alpha, so really managing concentration risk in the portfolio. So that's sort of how we want to generate strong risk-adjusted returns for clients and really, protect in this period of uncertainty and volatility. In terms of tariffs themselves, look, it's a bit of a wait and see, I think. Inflation looks well under control for now. But, what could this look like going forward? Look, we're a bit uncertain. We know that the effective tariff rate's going to go from 2.5% to 17% on what we know with those tariff announcements today. So prices are going to rise. Now, the extent to which that's going to impact the consumer, still a bit uncertain. Walmart said that they're replenishing inventories at post-tariff levels, so their inventories are going up and they're going to need to pass that on. So prices will rise. And I guess the other important point is the market is very complacent around this. You've got US equities at 23 times earnings. So the market's not at all concerned. And that complacency in itself is a risk. So that's sort of how we're thinking about all that uncertainty.
And just further to the uncertainty, just with the geopolitical tensions, et cetera, I mean, how are you positioning portfolios around that, and how should investors perhaps approach?
So again, you want to be. I mean, for investors and the way we think about it, our portfolio is your biggest protection is your discipline on valuation. You really want to make sure you're giving yourself that margin of safety in your valuation in case you do get those market drawdowns. Yep. So, the way, and again, you want to think about portfolio diversification. So just to give you a bit of a flavour, in our long book, we've got around a third in mature and cyclical businesses, but they're really focusing on market leaders, companies that won't be disrupted. And also looking for cyclicals, where we are taking that cyclical exposure. We want to have exposure to companies where that risk of a slowdown and, what uncertainty can mean on earnings, that risk is already being factored into earnings and valuations, so just giving us that protection. Then we've got around a third of our long book in our structural investment trends, so tomorrow's winners. We like cloud and AI monetization, we like onshoring and energy transition. And then we've got a third of our book in defensive businesses, so think healthcare, infrastructure, bit of gold exposure, some defence. These are less economically sensitive parts of the market or less economically sensitive companies. So, if geopolitical tensions flare up again or we get more uncertainty, we can lean into that part of our portfolio and protect our returns.
Yeah, I like that three-pronged approach that you've got there. You mentioned, like in terms of thematics, whether it's cloud, AI, are there other themes that we're not thinking about or you're looking and addressing that might be the next
So
big thing?
I definitely think that that very narrow focus on a handful of winners, you called it out earlier, the market is then not paying enough attention to that infrastructure investment cycle that is well underway, and it is being driven by the West's onshoring. And that's not going backwards. So that will certainly continue. The investment in the energy transition, we have to, globally we are moving towards those net zero goals, and a lot of investment is required. So we're finding lots of interesting exposure to that. And also defence, the big economic blocs are spending more on defence, and Europe has been a really prime example of that as well. So we've got European defence exposure in our portfolio. So we certainly like that part of the market. Now, look, AI is not going away. It's here to stay. And I think, what's been really interesting to observe over the last 12 months is the cost to use models has fallen by 100 times over the last 12 months, driven by innovation in hardware and software. And I'm sure you're experiencing this yourself. I know I am. I'm using AI far more than I was 12 months ago. I'm sure you're the same. I'm sure your clients are the same. So where we see value in AI, we see it moving away from being very narrowly played through those enablers or hardware stocks to the infrastructure layer and the adopters. So when I say adopters, I'm referring to companies that are cloud native and have large, well-organised data sets, because data is the asset here. Yep. And they're going to be able to incorporate AI easily into their business. They'll use it to drive productivity, cut costs, and enhance their value proposition to their customers. And they're going to be in a whole host of sectors, and they're not already being priced as AI winners. So one example in our portfolio is we own the largest digital consumer bank in the US. It's called Capital One Financial. Now, one way we think we can win from this is that it is this cloud-native business, and it's going to use AI, and it's going to use it to increase or enhance cross-selling of its products in its customer base, to better manage and price risk, and just to cut costs. And we're paying 8 times for that business. So it's certainly not being priced as an AI winner.
I'll put you on the spot. Alison Savas has got a spare $1. Outside your Antipodes fund, where do you put $1 today with a longer term view?
Outside of... I can't think of anything outside the Antipodes fund.
Of course.
Look, can I name a stock?
Of course you can.
Okay. One stock I really like at the moment is AMD.
And this isn't advice, by the way.
No. But one stock I really like is AMD. Now, clients might not be a household name, but AMD designs CPU and GPU chips.
Right.
So everybody knows what NVIDIA does, or everybody knows about NVIDIA, but people aren't really talking about AMD. And the really simple elevator pitch for AMD is that if it can get, we all know NVIDIA has a market cap of around $4 trillion. If AMD can get 10% of the GPU chip market, that, in simple terms, is $400 billion. Now, This is a company that today has just shy of 4% of the GPU market. If it can get to 10%, and it's $400 billion, today's market cap is only $250 billion US. Now, why do we think it can get there? Well, we think it can take that market share. And by the way, that's not a very heroic assumption going from, let's call it 4% to 10%. But why we think it can achieve that, let's say over the next couple of years, is that the big hyperscalers know they can't solely source their chips from NVIDIA. They need to have a second source supplier. And AMD is becoming that default second source. So it's taking market share with those hyperscalers. That's my pick for you today.
Terrific. Thanks for that. Look, very informative session as always. Appreciate Antipodes' time and your time today. For all of our clients, if you'd like further information on Antipodes, or just a general financial health check, please give us a call on 9003 4100, and look forward to meeting you next time. Thanks, Alison.
Thank you very much for having me.
Cheers.